Great. Welcome, everyone. I'm just going to give 1 minute for, great, excellent. We're all here. So welcome, everyone. Lisa Sachs from the Columbia Center on Sustainable Investment. I'm absolutely delighted to introduce and to co-moderate this discussion. One of the most wonderful and also critically valuable aspects of GRASFI, and especially the GRASFI conference, is the interaction between academics and practitioners in the field of sustainable finance. In the paper sessions, which I hope you've been able to join, we've been hearing about some really impressive cutting edge research that may portend trends in practice and should indeed influence practice. And on the other hand, academics have been asking really interesting questions of our practitioners, which will surely shape research inquiries. So this panel is focused on exactly that interaction. My role is very limited. I'll introduce our discussants who have all been my teachers in this field and then immediately hand it over, but I'll be staying here, keeping an eye on the Q&A. I hope that the Q&A is very active. Hopefully you see where it is on the right side of your screen. We'll post some of the questions there that we received in advance, because one of the other features of the Q&A is you can vote up the questions that you share. So I'll be keeping an eye on those, and we'll keep this a very active, interactive session. So with that, I'm really delighted to introduce three people I think need no introduction to those of you joining us today, but let me remind you of the incredible backgrounds of our three discussants. Jane Ambachtsheer is the Global Head of Sustainability at BNP Paribas Asset Management, where she's responsible for BNP Asset Management's overarching approach to sustainability, including sustainability research, ESG integration, engagement, advocacy, and governance. Jane has been working in this field for over 15 years, a lot of that time at Mercer, where she was chair of responsible investment, but I think also notably has contributed to many of the most significant initiatives related to sustainable finance, including the Principles of Responsible Investment, the Carbon Disclosure Project, the Financial Stability Board Task Force on Climate-Related Financial Disclosures. I'm sure that's just scratching the surface. Rob Bauer is a professor of finance at Maastricht University School of Business and Economics in the Netherlands. Also an incredibly prolific researcher, writer, and speaker on a vast range of themes related to sustainable finance, including pension funds, mutual fund performance, shareholder activism, corporate governance, and strategic investment policy, among others, and engages quite a bit with practitioners in that respect as well. He's also the director of the European Center for Corporate Engagement at Maastricht University and executive director of the International Center for Pension Management in Toronto. And Dan Esty is the Hillhouse professor at Yale University with appointments at the Environment and Law Schools and the Yale School of Management, and is director of the Yale Center for Environmental Law and Policy and co-director of the Yale Initiative on Sustainable Finance. And his research and publications are as diverse as all of those appointments would suggest, on everything ranging from environmental protection, regulatory reform, energy policy, and sustainability metrics, and their connections to corporate strategy, competitiveness, trade, and economic success. But Dan also brings to his research direct policy experience at the state level and the national level, including senior positions at U.S. Environmental Protection Agency in the past. And Dan is also just editing a fantastic book that touches on all these issues we've been talking about at the conference, called Values at Work, which I hope Dan will also mention and we've linked to as well. So with that, Jane, let me hand it over to you to kick us off, and I'm going to keep an eye on the Q&A.
Great, thank you so much. Well, it's a pleasure to be here, and Dan and Rob, thanks very much for joining. Really, at BNP Paribas Asset Management, we have really tried to tap into the academic literature that's out there on any number of topics around sustainability. And the investment teams are always kind of hungry for evidence and insights that can help to inform our approach. And I think that we've seen a huge growth in the amount of great work going on in the academic space around a whole different number of topics around sustainable finance. I think it's been a big change over the last 5 years in particular, and I think GRASFI plays a great role in that. But I still feel like there is a lost opportunity in terms of the amount of practitioner engagement and involvement with academics, both to help kind of ask the right questions and kind of shape the outcomes, but also to provide access to the kinds of data and real life situations that academics need to have access to in order to be able to kind of, that's really timely. So I think the fact that you've got so many practitioners and academics at this event, can help to break that down. But we wanted to kind of really foster that in this session, to kind of have that conversation and maybe even inspire some future research or collaborations. So I think just to kick off, it would be great to hear from each of you. How much of your time do you spend with practitioners, and what form does that take? Rob, do you want to go first?
Yeah, so it's okay. So actually, when I look back at my career so far, I always had two jobs. So even when I did my PhD, I did it at two universities, one in the Netherlands and one in Germany. But when I started working after that, I started actually working in the real world, in the institutional investment space, but also stayed at the university. So I think that was sort of the start of me interacting always between the university and the research agenda and how you can apply it in practice. And I think there's a very good reason for it. Because if you want to really make assessments based on academic research and empirical research, you face a lot of problems, whether there are really just correlations or causal relationships. And in a practical context, you can do a lot of things that you cannot do with data that are on a computer. You can, for instance, do experimental settings. You can go into a real case study. So I think that's a really important reason to do that. And I've done this essentially since I did my PhD in different ways. And I can talk a bit more about that later. But let's first give Dan some background.
Sure. Well, and Dan, I'd love you to comment also on that. I think that, Rob, there are many more Dutch professionals that I know that wear a double professional and academic hat than I know in North America. So Dan, also interested to hear how many academics in North America also, work in the kind of investment world.
So I think you've got a lot of academics that are finding the investment world of more and more interest. People are coming to it from different starting points. You've had some folks in business schools have been doing investment analytics as their core academic focus, but the sustainability dimension is new to them. And then you have folks more like I am who might be in an environment school or a sustainability program who are suddenly realizing that the flow of capital is a pretty important factor in whether we have a sustainable future or not. And, very much in my own experience, I've for 20 years been researching and writing on corporate sustainability, really as a matter of corporate strategy, and have spent time inside companies. So that's part of your answer. I think there's a whole world of academics who learn from sitting in a library reading books and articles, and others of us who go out and talk to people. And for my first big book in this space, Green to Gold, my research team and I spent time in 150 different companies. So we really went on the ground to try to extract the lessons from the practitioner world of the corporate sustainability arena at that time. And I ended up setting up a sustainability leaders group. And really what got me into sustainable investing in the investment world was the fact that so many of those leading companies were fussing that they were doing so much, but not being recognized by the capital markets. And they were wondering, why is it we're leaders, but that's not being translated into any recognition in terms of stock price or even sustainability evaluation.
So that's quite...
Yeah, jump right in, Rob, go.
Yeah, it's interesting that you say this, so they don't feel that the market recognizes it, whereas there are already studies on the academic market in the end of the first decade of the century that show that there is a connection with the cost of capital of these companies. Somehow that information is not translated into the real world. And I think that's why it's important that we discuss at the same table instead of at different tables about sustainability and corporations and the cost of capital. So I think this is a really good example that there is research. I have to say there's also a lot of research that is maybe not of the level that it should be in that era. But in the meantime, I think that it's quite, I would dare to say that there is a really causal relationship between sustainability performance on some of the material factors and the cost of capital, whether it's equity or bond, of firms. So why do companies not see that?
So Rob, let me jump in and try to give you an answer. And I think it goes to two other practitioner communities that we want to connect with. So one is the people in the companies that are trying to make sustainability work as an element of strategy. A second is the investor community and investment advisors. And I think there are a number of investors who want better alignment between their values and their portfolios. but their investment advisors are saying, "Oh, I don't know if the data supports this." And frankly, there's a fair bit of analysis that says, and this, Rob, you said, so I'm not going to pick on you, but I'd rather highlight something you said. Not every sustainability factor translates into financial reward. No. Some people are okay with that because they're impact investors and they want to gauge success by the delivery of social or environmental results, and they're willing to sacrifice something on the finance or profitability side. But I would also say, and this is the third community we need to get to beyond the investment world, is the data providers. And a lot of the private data providers have not kept up with the emerging granularity that the sustainability investors want to see. And frankly, there's on the highest levels, if you look at Sustainalytics versus MSCI, you'll see a very poor correlation between what they call sustainable. And that begins to cast doubt on whether there is even definitional clarity on what we're talking about. And I think it does lead some people to believe, whoops, this is not solid enough foundations on which to build a portfolio or really to create a sustainable investing strategy that performs as well or outperforms regular strategies.
So if we put the data quality issue to the side for a moment, and I think we should come back to that. But if we look at just the materiality question, right? So you touched on that. If there's a connection between ESG performance on a whole number of factors and cost of capital and company performance, how does that translate to investment performance? And Rob, we've talked a lot about this, right? What's in the price, what's not in the price? I would argue that the fact that there's so much dispersion between some of the ESG ratings providers, as evidenced by some of the papers being presented at this conference, would suggest that those investors that pay more attention, have better information, act on it more quickly, still have some advantage. But are we seeing that? I mean, is that coming through? Rob, what's your take on that from the finance literature?
Well, it's not an easy to answer question, but let me start with the simple saying that if a company is really doing well and ESG is related to performance, and we all know it, then it will be priced. The question is now, can we discover the real price of a company? So the price discovery process of sustainability information, is it as good as the financial information? I definitely don't think that's the case. So there is some upside over there. On the other hand, the information that is readily available and easy to interpret, in my view, will probably largely be priced by markets. What exactly that is, I think is mainly in the environmental space, more in the governance space, and less so in the social space of criteria. I think when you talk about the rating agencies, yes, it's the paper that we saw on the first day showed it all. I think that the information that we get from ratings, just like the information we get from credit ratings, is we pay way too much for that right now. I'm sorry for the people of the rating agencies in this room, because I think what we really want is information on the basic information, and the information that is sort of the data should be correct. That's what we want. And of course, it's very difficult to measure the employee satisfaction of a firm. You can do that in 100,000 different ways. So if you want to measure that, that's difficult. But to measure the CO2 emission, carbon, or any other environmental, easy to calculate metric, that should be easy, but it is apparently still not the case. So if you can do this better than others as an investor, you can make a profit out of that. But I think it's very difficult. You're competing with all the other usual suspects that are also competing in active markets, on other information. So it's not an easy job.
Yeah, and what about looking backwards? Sorry, Dan,
let me just add if I can. Yeah. I think Rob's pointed out some of the issues, but let me just highlight a couple more. One, I think, is that the folks that are putting the data out there are better at looking at downsides and risks than upside opportunities and potential for growth. And that argues that we probably need an additional set of metrics that give us clarity on that. And, I think there is, and this is why a lot of my research has been on rethinking and refining the ESG frameworks. And I've been arguing for something we call the value driver model, which would focus on growth and productivity as much as risk, and really trying to get a better gauge on those. And one of the questions that's been popped into our Q&A adds to another dimension of this, and that is there's much better qualitative information or quantitative information in the environment arena, but when you get out of the E to the S and the T, you become much more qualitative. And by the way, those are still very important issues, maybe defining which companies are going to do well going forward, but we don't have as much of a firm analytic foundation. And I would say beyond that, we really are seeing, I think, an emerging structure of people trying to refine the analytics and really trying to give a firmer foundation. And that's what my new book that Lisa mentioned, this Values at Work, Sustainable Investing and ESG Reporting, looks at, with essays, by the way, Jane, back to your original point, from practitioners as well as academics on where they see this arena going and what's needed to really take it to the next level.
Yeah. Well, look, a comment and then a question I would put back to you guys. I mean, the question that came in around the G and the S being more qualitative. I mean, I think it can be more qualitative, but I think there's a cultural and a regional dimension as well. If you look at some of the corporate governance indicators, the role of independent directors, independent chair, board diversity, there are significant regional differences as well, where you may have the data, but you may not be able to directly compare regions. And, we have struggled with that as a global investor, investing across markets around, if you have a voting policy on board diversity, should you have the same expectations for every country, because they're starting from different points and they have a different regulatory context. But to ask a question around,
let's pause there if we can, Jane, for 1 minute, because I think you hit on something very critical, and that is the normalization of the data to make it comparable, and in that regard, really separate leaders from laggards, recognizing there is some diversity in circumstances. And Rob was kind of saying, gee, it seems like there should be on something like climate change and greenhouse gas emissions, a firm, analytically rigorous, comparable database of emissions, because these are measurable. And the answer is yes and no. It turns out, and my team at Yale has been working on this, that there is quite a wide range of ways that people report on something that's even as well defined as greenhouse gas emissions. Some people report scope 1, some scope 1 and 2, some scope 1, 2, and 3. Some report scope 3 not very fully, focusing maybe just on their business travel, but not on the impacts of their products. And if you don't have someone really working to normalize all that, you can frankly end up with a data result that is upside down and wrong. In our first attempt to analyze the auto industry, for example, we came up with Tata Motors using the existing data in the marketplace as the most sustainable company. It was just a joke, but it turned out they weren't reporting as fully as other people, although they claimed to be filling out the form with all 3 scopes.
And then you finally know what you want and you start normalizing, but then you normalize differently than someone else. So it's even that is not easy. So
yeah.
yes.
Well, I have a success story from last year's GRASFI conference, actually, where we met an academic who'd done a paper around building an internal carbon emissions estimation model that we have partnered with to work on developing that internally within BNP Paribas Asset Management. Because we find that, we cover 12,000 entities in our ESG scoring platform. We use carbon emissions, scope 1 and 2, both. For now, we're working on scope 3 as a factor in how we actually rate companies, but also for reporting. But only about 25% of the universe comes from direct company reporting, which even, that needs to be cleaned and controlled. But then how do you estimate the other 75%? We're finding that our new model is much more accurate than the data that we've been buying. So that's something that's been, I think, a great example of academic practitioner collaboration.
And there should be more of that, because that's really how we're going to get beyond the kind of data foundations being so shaky, which leads a lot of investors or investment advisors to be underconfident that sustainability is part of an investment grade framework for analysis.
I think one big other issue needs to be solved to even start doing this properly that we haven't talked about yet. When you look at the way institutional investors actually measure performance, it's, I would say, close to 1900, the 19th century finance. So essentially, this is the return of the benchmark, and this is my return, and that's it. That's what we did in the 19th century. Some of them actually look at it like, let's say, the 30s or the 40s, where they correct for some kind of simple risk assessment. Very few look at capital asset pricing model, betas corrected, or any other way of correcting for risk. And even less of those look at the recent performance attribution models that we have to really assess whether you add value. So what happens? So suppose you invest in a bunch of companies that have low risk because of being exposed to low ESG risk, whether it's environmental, social, or governance, doesn't matter. As a finance 101, you would assume these companies to have low returns by expectations, to have low risk, versus the benchmark that is of higher risk if you have a low risk portfolio. But if you do not correct for these risks, this ESG risk or any other risk that I'm making, you make completely the wrong decisions and you're completely assessing in a wrong way all portfolio managers. If we do not solve this, and it's not just relevant for the ESG space, by the way, also for active management in general, we can talk for hours about this, but we're not going to solve that the capital goes to in the right direction. So I just wanted to make this point. Not sure what Dan
well, and
thinks about this.
so this leads into my next question, which is really around, so much of the focus on performance measurement has been, by design looking historically, right? What can we learn? But if we look forward and we know that, so many externalities are not currently priced, firm profitability would be very different in a scenario where we had, much more appropriate levels of carbon pricing, not to speak about biodiversity and some of the issues there. So looking forward, and this really ties into, our philosophy as a long-term investor is that, we have not only the opportunity, but an obligation to try to influence, policymakers, companies to, kind of act within the scarce resource environment that we exist within around carbon and other natural resources, et cetera. So I feel like there hasn't been as much academic work done to really help to support the fact that, or to support the argument that if we don't steer towards a more sustainable path, long-term investors are going to suffer, not just in the super long term, right? We're already feeling impacts of extreme heat, other climate impacts. So I think part of the problem is that, to really bring that together, you need more work from a multidisciplinary perspective, right? Natural scientists, finance, et cetera. So, how can we kind of push on that front? And do you get asked about that a lot?
So Jane, let me jump in on that if I can.
Or Dan, go for it.
It echoes, in fact, one of the questions on our Q&A board about what happens when companies actually do better by doing poorly on ESG factors. And it really goes to your point, and that reflects a regulatory failure. If we're not internalizing those externalities, companies actually may be more profitable by cutting corners and not paying attention to sustainability factors compared to their competitors who are trying to be on the right side of some of these mega trends. I've called sustainability a mega trend of the 21st century, and I think companies face a sustainability imperative. But that's over the medium to long term. In the short term, there may be cases where people who don't pay attention to these issues will do better. I think, and this is where academics are stepping up to the challenge, I think there's an emerging focus on this. I myself been writing about what I call the end of externalities. I think that especially as we have increasing sophistication of regulators, more transparency, more data reporting, even if not fully scaled and normalized properly, it's going to be harder and harder to have a business model that fundamentally depends on imposing costs on society, whether that's pollution that spills on the neighbors to the factory or a wage model that leaves some of the workers incapable of managing on their own and needing support from social welfare systems. I think you're going to see any business with an externality-founded model for business success really called into question. So I think we're headed for an end of externalities. Not that there will be no pollution, but I think there will be an end to externalities that are not called out, and frankly, in the environmental context, where people are not forced to pay for them. I expect full pollution pricing over the next decade. And I think it's going to make it easier, Jane, for you as the...
Globally?
Starting in the United States and Europe. And I think the transparency will still be there, because that's another thing we haven't talked about is technology opportunities to capture some of this missing information. If you're concerned, for example, about the oil and gas industry, and one of the big issues is methane leaking, it's increasingly possible from a global satellite perspective with a geographic information system to spotlight who's causing the problem. And I think having that information out there is going to cause investors looking at the longer term to turn away from those who are cutting the corners, putting the emissions up there, and will, one way or another, and not just in the United States and Europe, but globally, be called to account in the coming years.
Yeah.
Okay.
Rob?
So And what I would like to add is a bit of a different dimension. It goes back to your first question, how to involve companies in all of this. I think that if we have a problem, let's say global warming, or how to look at a certain externality, how you can internalize that, you have to start defining the problem and start having a solution for the problem. Now, what do we do in academics? We tend to work together in our own field. So if I, as a finance professor, work together with a marketing professor, it's deemed eighth world wonder. I think we need to not just think about multidisciplinarity, which essentially doesn't really go beyond your field. We don't even have to think about interdisciplinarity, where certain fields work together on a problem from a different perspective. I think we have to sit down with different people from different fields, with different backgrounds, natural and social sciences, and then jointly tackle the problem. So I wrote a paper on the impact of heat on the cash flows of companies globally. So how high degree days impact those cash flows. It's actually quite almost a shame that in my research team it's just economists who don't have a clue about physiology, geology, climate change, science, etc. Still, I'm writing a paper on this. So I'm sort of conditioning on what others have done on that. I think that's where it all starts. If we do not really cooperate across the fields of science, we will never tackle the problems in a very efficient way. That's something I would
And
like to add.
is just a follow-up question before we turn to Lisa with audience questions. Is GRASFI particularly well placed to help do that, or how are you guys trying to kind of catalyze that?
Certainly not. GRASFI right now is even within sustainability, let's say the Sustainable Finance and Investment Research Alliance. You know, Esty won the Nobel Prize last year with a team of others on development economics also. And development economics, you know, they really measure the impact with RCTs, randomized controlled trials, of a certain intervention. Much better than a lot of financial economists try to correlate certain ESG information with certain characteristics on the stock market. So I think GRASFI definitely should cooperate with others. Whether there would be one GRASFI where everyone is in, I don't think that works. So you have to really think how you organize that. But I definitely we should maybe think about future events where we have a session where we invite the natural sciences to come in. Or if we have papers that are cooperations between people from different science fields, that we really put them on the stand and show off.
You know, I agree. I think some greater emphasis.
We had a climate scientist come in. Sorry, Dan, go ahead.
No, go ahead.
Oh, I was just going to say we had a climate scientist come in and do a bunch of training sessions for our investment team, actually, just to help them kind of understand the science of climate change more specifically. I mean, but that's a pre-step to kind of collaboration. Lisa, did you want to bring in some audience questions?
I don't want to cut the flow, but just a couple of questions that are coming related to things that both Dan and Rob had touched on. Dan, you were talking about that you expect more regulatory action that will force companies in a way to internalize externalities. And one of the questions says, one issue under-addressed in ESG ratings is corporate practice with respect to regulatory capture. Capture enables companies to do well while doing poorly on ESG issues. How can we address that? I just wonder, in your projections that you think within the next 10 years, that regulation will force companies to internalize that, if that's accounting for how much regulatory processes, at least in the US, are captured by corporate interests?
Well, first of all, let's be very clear. Regulatory capture is a problem everywhere. And I think this is the issue that I'm very focused on, because I think it does mean that companies who are engaged in that capture process are then conducting business in ways that spill harms onto society as a whole, and you're effectively privatizing gains and socializing costs. And I think that is, again, it's going to be fundamentally unacceptable as an ethical point of view, I believe. We're seeing a shift already in a recognition that we're not simply in a world of shareholder primacy, where everything you do to improve profitability is acceptable. We need to have more of a stakeholder perspectives, recognize stakeholder responsibilities. And even some of the big business groups, like the Business Roundtable in the United States, have come to understand that those include communities you operate in, your employees, your suppliers, and frankly, society at large. So if you are profiting at the expense of society by putting greenhouse gas emissions up in the sky, or you're profiting at the expense of the neighbors to your facility, your communities by spilling harm out the back door in the form of toxics. I think this is no longer ethically acceptable. And I think, frankly, it's going to be increasingly hard to get away with it because of the world we live in, which much easier methods of capturing that harm, whether it's a neighbor with a cell phone taking a picture, or an NGO calculating greenhouse gas emissions and posting who the big emitters are, including those that are doing it legally because they've engaged in regulatory capture. And I think these other forces are likely to drive us to a world where even before regulation forces businesses to take seriously some of these limits, these spillovers of harm, there will be a society demanding it. And frankly, a lifting of the social license to operate for companies that aren't seen on the right side of some of these tracks.
From an investor perspective, actually tackling corporate climate lobbying is one of our particular focus areas. And we've partnered with a few other investors on this. And in the US, this year, we were the lead filer on 4 shareholder resolutions on this topic, and actually had a majority support at Chevron in the first year that we filed this resolution, which is, I think, pretty unheard of in the context of shareholder resolutions on climate and climate-related lobbying being quite a new area. I think it would be a great topic for more academic research, like why have we seen such a swift pickup in support for these resolutions? I mean, I think we kind of intuitively know why, but as a leader for change, I think it holds a lot of opportunity.
But then we even do not unleash the big potential of all those citizens of this globe that also have an opinion on this. So they're not allowed to vote on everything that is happening in these companies, but they own large parts of the financial institutions that manage their money, like, for instance, pension funds. So what I've seen in Europe is that, and even now happening in the US, is that groups of individuals just start targeting companies on certain issues. And if they do not respond, they go to the shareholders, and the group that is easy to approach is the pension fund community. And they start saying, you have to do something with my money, and if you don't, we'll make your life miserable. So you see that these pension funds have to act, and that's what's happening essentially right now. I think it's a pity that Johnny Cash lived 50 years ago or 60 years ago when he fought for the rights of the indigenous people. Because if he would have had social media and the pension funds working for him, he would have had a better outcome, I think. I hope this is not
Lisa,
too much
some
off
other
topic.
questions.
Sorry, didn't want to unmute me. Yeah, sorry about that. Sticky keys. I think building a bit on these questions, there are several questions that relate to the question of identifying, quantifying these externalities, and how research can help. Some of them speak to specific types of risks, like the wildfires and others, and whether we're supporting practitioners to properly anticipate and price in these risks. So I guess building on this question and what you're both describing of outside government forces that are going to that might push action. Is there more that academics can be doing here to be identifying the externalities, quantifying the externalities, anticipating and quantifying the risks? I'll maybe end by saying that I know my colleagues at Columbia University have been poking holes in current measures, for instance, of water-related risks, of climate risks, et cetera. So to Rob's point of more interdisciplinary research, but also to Dan's point of trying to push an understanding of these externalities, is there more that academics can be doing in this space to push the field?
I would say absolutely so, and probably in partnership with some of the people in these industries. Because if you're on the sustainable side of an industry, you don't want to have your competitors running around the back and making money at your expense. So I think having some industry academic partnerships to try to get better data, to really on an almost industry by industry basis, identify where the spillovers of harm might be occurring, where those externalities are that should be tracked, and then brainstorming together. From my experience working with companies, almost always the people that know best how to track things are the ones inside the businesses who in the wrong companies are actually the ones responsible for releasing the harm. So getting them to help explain the methodology that might be necessary for an academic to track it, or for that matter, for policymakers to require a certain kind of reporting would be very, very helpful.
I think what I would like to add is the importance of engagement, whether it's by shareholders or by anyone else. And a good example is the tobacco industry. So you can easily calculate the externalities there. So it's not a problem of calculating the externalities. It's the problem that portfolio managers, who probably are portfolio managers because they have a certain way of thinking about life, money is important, they buy them, even though they know that these externalities are there. So if that's the case, we have to go one step back and ask ourselves, why do we want to have tobacco companies in our portfolio? So I think that goes back to what I said before. Lots of citizens don't want these companies in their portfolio, but they still are. You probably heard
But Rob,
of
I mean, doesn't it come down to the inverse relationship you talked about, you know, ESG risk and return and yield? And so, I mean, they want these high yielding companies, you know, up until the point that they go bankrupt. So, I mean, it's a time horizon arbitrage issue that I think we need to engage the investment community on. So, I mean, how can academics kind of help to set that out?
So you say it's a time dimension and it's about yield, but I did several behavioral experiments with clients of financial institutions, both pension funds, but also people that bought mutual funds. And if you ask them what they want out of a portfolio, it's not just yield, returns. It's also something else. And I think we should spend more time on what that exactly is, how to measure their utility of non-financial preferences or social preference. I'm working on that quite a lot. And I think the tobacco industry is also a great example. You can look back and see that they had great returns and high dividend yields and all that. But I predict, and I'm the last person to predict anything because I believe in quite efficient markets, but I predict that the tobacco industry will go down further as they already have been going in the last 2 years. And look at Exxon, a company that did not listen to its shareholders. Look at their stock price and look at the stock price of their competitors. So I think how can we effectively engage? How can we collaboratively effectively engage? And how can we engage in such a way that our clients or beneficiaries, whether it's of mutual funds or pension funds, doesn't matter, even insurance companies, when they're happy with what you're doing, you are way more effective. And if you don't do it, they will either leave you as a client or they go somewhere else to get there.
So let me just add.
And I mean, there's a regional dimension here, right? Where, you know, in Europe, it's going to become mandatory that investors need to seek the sustainability preferences of their clients. So we'll see that coming into play even more. In North America, of course, we've had a very strong divestment movement around, I mean, over the last few years around fossil fuels. Really kind of, you know, indicating preferences there. But I would argue that there's much less, you know, aggregate work going on in North America in terms of surveying individuals to understand their preferences. So, I mean, you know, I'm not sure, you know, there's a regulatory push for that in Europe. I think, you know, academics have looked at it, you've looked at it, but it's pretty nascent.
Yeah, I'm not an Anglo-Saxon lawyer. The only thing I know is from Matlock, and that's it. But but what I can tell you here is that whenever I try to speak to a communication department of a financial institution and I say I want to measure the preferences of your clients or participants or whatever, they start freaking out because then the word fiduciary duty comes in and you know, it's even forbidden in the UK to ask this and do something with it because fiduciaries have to make a decision on their own. They cannot be influenced by the beneficiaries. I think this is a lot of bollocks. So I think we should really have, again, a step back and see why are you investing in the first place?
Let me offer a further thought as an Anglo-Saxon lawyer. No, despite being an Anglo-Saxon lawyer. But I think the bottom line is several of the things we've now gone over very quickly, and I just want to pause and draw a line under them. One is short-termism. As long as markets reward companies that produce short-term profits, and we don't have a better way to gauge prospects out over time, there is going to be some distortion. I think there is also some divergence in visions of fiduciary duty and even legal requirements. The Trump administration has put forward rules that would make it illegal to consider ESG factors in constructing pension portfolios. So this would really drive us in quite different directions. And I think it continues to be the case that we've got a significant number of circumstances where the best sustainability performance does not translate into financial results. And I think that does require us to get to better measures of who is not just a sustainability leader in some overarching way or in some niche, but in a way that will translate. And I do think, frankly, some of the efforts around materiality are going to help in this regard, especially if we get into a frame of understanding that materiality can't be the kind of materiality that the U.S. Securities and Exchange Commission has historically focused on, which is relatively short term and relatively narrow in thinking that it's all about financial results. And I think there's growing sentiment, including reflected in the Global Reporting Initiative, for example, that materiality should encompass environmental and sustainability factors and longer, not just shorter term things, to give a more rounded picture of who these leaders are out over time.
Yeah. So two other things coming through the questions I wanted to just throw in there. There's a comment that, a lot of the academic literature, particularly in the finance and investment space, has focused on listed companies, particularly on equities, but also on debt, but listed companies. What about private companies, right? I mean, private, infrastructure investments, private equity. If you think about a lot of the development that's going to take place physically over the next 15 years in emerging markets, I mean, it's either going to save us or lock us into a high carbon pathway. What's academia doing about kind of that massive part of the capital markets?
Yeah, it's very tough, because data availability. So when you look at how big investors do this, they have their processes when they buy some private equity, that there should be some kind of an ESG screen in general, or that you maybe select even specific solution, renewable energy type of private equity. That's all in the private domain. So how do you get to that information? And even the information you can get publicly, don't trust it. Ludovic Philippou can tell you all about that. So it's very difficult to actually study that. So probably you cannot go beyond case studies where you can get access. But whenever a private equity firm gives you access to their private equity in very much detail, I get a bit, what's happening there, So I think that's what keeps the academics up. If you, however, would sort of start from the start, when the private equity firm starts, some collaborative initiative, in academics included, well, I think people at the start of a company have something else on their mind.
So let me just...
But isn't GRASFI a great example of that?
What do you mean,
GRASFI an example?
Well, GRASFI being GRASFI, the sustainability real estate benchmark, where you had academics and investors.
Yeah, so GRASFI, so that's a global real estate sustainability benchmark. I was one of the founders of it. There we started looking at the private real estate funds ESG performance, but it was essentially, why was it a success? There was an academic paper it was based on, so there was some solid research published in the American Economic Review, a solid journal. And there were a few investors that said, we want to do this. And this is why. And you companies have to cooperate. And if not, you have a problem. We will divest from you. That's essentially the story there. Whether you can do this in the private equity space, we thought about that. We actually thought about making a private equity benchmark. And we sat down with all these venture cap associations. And, after a few conversations, we stopped. Because
I think there is some changing thinking within the private equity world. And one of the chapters in this book forthcoming in November, Values at Work, is by Cristina Alfonso Ercan of Madeira, really trying to lay out what's going on in the private equity space with regard to sustainability. And I can't say that it's got the data analytics that Rob would like and I would as well, but it does start to map the space in a kind of way that paints a picture of a changing world, where a lot of these private equity guys are now being asked by their sources of capital to explain themselves, to provide data on their impacts. And so I think, again, this isn't going to happen overnight. It's probably behind where we'd like it to be. But Christina's chapter in this book is a nice mapping of what could happen, and frankly highlights some of the leaders who are out in front in, again, I wouldn't tell you putting all of the data out there, but starting to ask for it.
But that's a good point, because what would be great, suppose you have 50 large pension funds across the globe, for instance, those that are in my center in Toronto. It would be great if all of them anonymously gave all their data on private equity investments and how they interacted on ESG anonymously to a group of researchers that are going to study them. Try to do that. with 50 organizations with different backgrounds, different geographies, try to get the information from the private equity firms. So it's very difficult to really assess the quality of the information and to find any direction. But yes, if you could do it, that would be great. So I think we need collaboration and coordination here, and it will take time.
Totally agree.
Okay, so really it's the investor access that could support the academic research. So it almost demands that collaboration.
Access and then
yes.
commitment.
So another question was around the focus on developed markets.
I was just saying access is a starting point. And then there's got to be some transparency in the sharing of real numbers.
Yeah.
Right, yeah. In terms of, the other angle, developed versus emerging economies, and this is another topic that's come up. A lot of papers tend to focus on developed economies in terms of the market benchmarks. I think we've seen a lot of progress over the last few years in terms of both reporting and data collection in a number of emerging economies. But I mean, we struggle for sure in terms of getting high quality data in all regions. And also around, kind of accessing capital structures and mapping organizations to all their subsidiaries and trying to figure out, what do you do with state-owned enterprises? Should they have a corporate ESG score? Should they, derive a score from the sovereign? There's all kinds of elements when you're getting into different kinds of emerging markets. So where do you see academia really kind of tackling that or digging in there?
I'll start and let Rob continue, but I would say that the academic community is very interested in global flows of capital, particularly the people that care about creating a sustainable future. So there's a lot of interest, and I would say my own research is not gotten into the data on this as much as what's conceptually possible. And I would say that we're starting to identify places where the developing world is stepping up. And one of the ways this is happening is through stock markets. So I would point to, for example, the Johannesburg stock market that's done quite a lot in developing an obligatory set of sustainability reporting requirements. I've called for recently in a paper with my colleague Todd Court that was published in the Journal of Organization and Environment, a mandatory government-backed structure of reporting on ESG coordinated internationally, so you begin to get comparability. And again, there is an association of stock markets that is working on some of this. And I think if the big players from Europe and perhaps a new administration in the United States were to concur on the value of a mandatory framework, and by the way, there's some nuance to that I'm happy to go into if people want, but a starting structure, a core set of metrics, and then a second set of industry-specific issues that matter in a particular case, and to coordinate that across jurisdictions, across geographies, you could really step up the game in a big way and bring developing countries into the fold, reinforced by a structure that they can develop with others, but can also rely on others to help insist gets fulfilled by the companies doing the reporting.
Yeah, I think it's almost like an evergreen for academics. Think about it. If you are a finance academic and you want you write a paper on the U.S., chances of being accepted are like 10 times higher than if you write a paper in general about emerging markets. I think a real researcher should not be, let's say, I hear some noise, should not be influenced by that. But the data is just difficult. Although in this particular GRASFI conference, I saw a few papers on Africa. So I think that already shows that there is data available, and with new techniques that we have, you can really do a lot. But I think if you look at the asset markets, so emerging market equity and debt, data on ESG for emerging markets is of a way less quality even than data for developed markets. So it's a risky strategy for a researcher to go in there, because you don't know whether what you're doing makes any sense if the data quality is not good enough. So the only thing you can do then is to go into these markets and do maybe more a behavioral setting, as I said, randomized controlled trials is a way of finding out whether certain interventions in companies or societies are helpful. But it's a struggle.
We had that one of the papers actually that you mentioned on pricing of renewable solar assets in Africa. One of my colleagues, we reviewed a number of the papers, and he loved it. He thought it was really well done and really interesting. So congratulations to that author.
Actually, a spin-off of that paper, if I'm correctly informed, was also published in Nature Energy, sort of a related paper of it. So there you are. That sounds like multidisciplinarity.
That's right. Rob, a quick one
least.
for you that came.
Yeah.
Do you feel that modern portfolio theory needs to be revisited?
So now I'm a strong believer in modern portfolio theory, and that you should teach people what an equilibrium model like modern portfolio theory or the capital asset pricing model is, so that they start thinking about risk return. But of course, that particular model with all its assumptions will not describe the reality. But I think to start off with that, we would definitely keep on teaching that model so that you understand what finance is.
Okay.
And then the next step is you go in depth and you try to integrate elements that could distort this equilibrium. And what does that mean then? And what can we observe if that happens? And I think we do not have the theoretical extensions yet there. There are some starts of that in the Toulouse School of Economics. Some people are working on this. So I think that will take time.
I mean, it really ties back to the pricing externalities, right? Bringing in the externalities,
I was just going to say,
the kind of impact dimension.
I think what you see is just as economics broadly once had a view of a rational individual as the foundation and has had to refine theory over the last decade or two with behavioral economics. I think you're going to see an increasingly sustainability refined portfolio theory emerge. And in fact, that for the young academics who might be listening in, that's quite a fertile area to go into, to take on a prevailing theory that's had huge impact and say, well, it's incomplete, or it would do better if the following things were folded in, including, Jane, your point that started the question, which is let's capture these externalities and understand that markets don't work perfectly if there is uninternalized spillovers of harm that are not being captured. We can't count on them to optimize.
Didn't the PRI actually do a call for papers on reinventing or evolving modern portfolio theory a couple of years ago? I'm pretty sure that they did.
Yeah, I get some recollection
of
that
as well. I'm not sure it produced the breakthroughs that we're hoping for.
No,
right.
But I think, what it essentially means is if you look at these models, they assume certain utility functions that investors have, where risk and return are describing everything. And of course, if what I said 10 minutes ago, investors get utility from something else than risk and return, for instance, to have the expectation to live in a great world after 20 years, then prices are fully different in such an equilibrium model. Maybe there's even an equilibrium if that. So I think that's what we have to look at. What if there is and there are some papers on that, very theoretical papers that show that if there is a group of people larger than a certain percentage in the market that have this view, that it will distort markets and you get different pricing mechanisms. So, but that's very theoretical. And what we observe is a mix of everything we think and do. So it's very difficult to actually empirically test those models.
I think it would be a great area of continued focus. I mean, I think it's so central to how tens of thousands of finance practitioners are really trained. And until we have a really kind of central and structured way to help them think about externality pricing and to evolve their models in terms of, feeding that into decision making, we're going to kind of still be at the fringes, I think.
Send your children to the Maastricht University Business School, because we have a Master of Sustainable Finance. That's where you can teach this, learn this. But of course, we don't have the equilibrium model either. So sorry for that.
Lisa, did you want to ask a couple of other questions that have come in?
You've touched on so many of these, so I'm not sure there are any in particular. I think one strand maybe that could guide final remarks from the panelists, because it relates to everything you're saying, but it keeps coming up in the questions, is the divergence between, or how to manage those who want to accurately price in externalities and can take that long-term view, and those who are still driven, whether by regulatory requirements, as in the United States, or by short-term investor interests, to focus more on short-term returns. And so I feel like these are two different academic strands, but reconciling them seems paramount, which is how to, on one hand, we've talked a lot about what resources can guide those who want to properly price in externalities and how to make the case for that. On the other hand, how to address what might be a growing divergence and in the regulatory guidance of the U.S. or firms who seek not to do that and may, as you were just talking about, distort the market. So I guess that is a strand that keeps coming up in the questions, and I wonder if maybe some final remarks might touch on how to manage that tension.
Yeah, maybe. Yeah. I have something to say on that. So I organized a debate a few days before the lockdown, where I put just a simple line on my university for a certain webinar, not a webinar, a conference, on divestment versus engagement of fossil fuel companies, essentially this question. And I was able to get the head of the ABP investment division, so the pension fund, the largest pension fund of Europe. And I had a company in there, and I also had a student in there. And the room was filled just with students. So we had a debate, all the usual arguments came in. And then sort of like 70% of the time, somebody stood up and said, I listened to all these arguments, left and right. And I can understand that some people say we should engage because they are important for the energy transition. And I can understand that some people say we have to divest because they are just bad companies. But, I read a paper yesterday, the student said, that we have only a few years left to really change this. So how can we talk so much about it and have horizons of... So don't underestimate what this young generation thinks of this. And I think financial professionals, people of my age and older, they don't think about that enough, in my view. So I think we should really go more to the general people that we are investing for. And then that pressure will prevent regulatory gaming. It will prevent making stupid decisions for the short term. And I think that how to untap and unleash that potential, I think that's my challenge for the next few years.
So I would just echo that and say that's why my new book coming out this fall is called Values at Work. I think what you're going to see is just as societies have been turned around on issues of racial justice, structural inequality, around a younger generation of people saying that the old models don't work, the old accepted assumptions aren't okay. I think you may see that emerge in the investor world. I think one of the big points of recognition is that we're not going to get to a sustainable future unless capital flows towards companies and projects and infrastructure that allows us to decarbonize and address other sustainability issues. And frankly, it's not just sending money to the companies that are leading the way, it's pulling money back from the projects or the companies or the industries that are not. And I do think the way you get pressure on that is for people to stand up and say it's actually no longer okay for people to profit, including as shareholders of these companies, if the expense is borne by all of us as a society. And I think the first step is to measure it, and the second step would be to regulate it. But even before we get to full internalization by law, I think you can expect to see some pushback from these folks that Rob has just mentioned, the younger world that's got a different set of baseline expectations and of prevailing values. And one might even argue it's part of the attack on privilege, the idea that certain companies could get away with certain things because it's always been done that way. Oh, that's no longer accepted in any domain. And I think there are going to be companies who are called to account for business models that are fundamentally unworkable, absent this externalization of costs onto society in one form or another.
Great. Thanks. Well, I think, we could probably carry on for another hour, but our time is almost up. This has been incredibly interesting. Just a tidbit on something we're doing internally with our investment team is we've got an ESG champion in each of our different investment teams, in addition to the sustainability center with my team. And so we've got about 60 ESG champions across investments, and each of them has committed to undertake a formal professional certification of some type on ESG. So the CFA has a new ESG certification. The European Society of Financial Analysts has a SEDSCA certification that 20 or so of them have done. SASB has the fundamentals of sustainability accounting. And I think they're finding it really valuable. So if we've got practitioners dialed in, that's, I think, another way to access a good overview of what's happening in the academic world. And then Professor Caroline Flammer also pointed out on the chat that the PRI also has a great academic network. and they've got a resource you can look online where they have a library of academic papers kind of classified and sorted by category, which is also, I think, a really excellent resource for folks who want to kind of continue to access high quality academic work. So with that, Lisa, I'll hand it back to you.
You, Mike. Thanks so much. As you said, Shane, I selfishly wish this panel could have gone on for much longer. Well, actually, one point that I'm going to plug for Dan and Rob to help us think about a bit later that you've just said, I absolutely love and couldn't agree more with the focus on the younger generation and the students. And I think one question that now I wish we had gotten into is whether we're teaching these topics comprehensively, fully, whether, you know, business school management, other schools' curricula has evolved to ensure that all students are getting this perspective, or at least those who want to are getting this perspective. So now I wish we had another hour.
But just a quick reflection on that. You know, I think we do have at Yale a Yale Initiative on Sustainable Finance. So this is a structured part of our research program. Rob mentioned there's at Maastricht a sustainability effort. For those interested, we have an executive MBA program at Yale that's got a sustainability emphasis to it, a sustainability certification behind it. So for those who are interested, there are programs where you can really get this front and center, although all of us know there's more work to be done. And frankly, the real gauge is not whether there are these programs, it's whether all of the MBAs and all of the folks getting trained in professional schools everywhere beyond the business world are getting that sustainability foundation.
Yes, I participated in two forums in June. One was organized by Kellogg, in combination with several schools, maybe also Yale, maybe also Columbia, I don't know, and also a few Europeans, among others, Maastricht. They have sort of a task to let's say organize this education for sustainable finance and impact investing. So lots of universities in the US and Europe are working jointly on making this education available. Of course, in a public system, it's easier than in a private system where we have to compete for, especially in a COVID. I think there's also on the new GRASFI website, a list of courses that GRASFI universities are delivering for across all universities. So I think there's quite some choice, but I fully agree with Dan that we are at the start of this. And I think we should make this a public good. It shouldn't be competition between business schools, but we should make this a public good, and it should be free for everyone. So maybe some of us should write a book on this.
I'd suggest 3 co-authors right here, co-editors. No, that's great. Thank you so much. And I think I think that there's a panel actually tomorrow with Global Prime, which is looking precisely at how these questions could be integrated with in management.
Yes.
So
that's the other one. Yeah. So yeah, Metamorphosing.
Exactly.
That's the other that I didn't tell you. You know, Prime also did that.
So great. I'm going to make sure that this discussion feeds directly into that tomorrow morning. We'll share the details of that. This has been inspiring for us who are in academia, and really thank you very much for sharing these thoughts. We're downloading all of the Q&A so that we can continue the conversation in a variety of fora. But thank you very much for all these observations, and hope to see many of you back in about 45 minutes or so for our final session of the day, looking again at the role of the corporation, which again touches on many of these same themes.
Okay.
So
thank you.
Thanks very much.
And thank you, Jane, for great moderation.
Thank you.
As a number of
Thank
people
you.
pointed out.
Absolutely. Yes, absolutely. Thanks very much, everyone.
Thank you.
Bye-bye.
Okay.
Bye.